And switching gears, Australia might be lagging behind the rest of the world with the vaccine rollout and combating COVID. Around the world, vaccination rates are ramping up and leading to stronger global growth prospects. So what do we do? How do we invest in this current environment? Grant Patterson from Providence Wealth is going to run through a few answers. Good morning, Grant. Goodness me, what a weekend we're facing here. It's a sea of red. It's a sea of red today. I guess it's probably almost a bit of a correction to what we've been talking about. But really, we're still not away from the big picture, which is inflation. Is it transitory or not? And if it is transitory, do bond yields stay down here for longer? And what does that mean for investors?
Well, it's a very big question, Annette, and good morning. Yes, it's certainly one of the concerns that most investment committees have at the moment, whether the inflation numbers that we saw out of the States, which was spiking up to around about 5% on an annualised basis, whether that's a transitory impact because of supply bottlenecks and also low inventories, or whether it's something more sustainable. Certainly the bond market has spoken. The bond market believes that it's transitory. I think it's been surprising how the US 10-year bond yield has come back from around about 1.9% down to the current 1.3, 1.29. So the jury's out, I think, and that's why I agree with your previous speaker that I think it's very, very important for the protection and preservation of capital, particularly after the very strong financial year to date we've just had, to remain very diversified across all the asset classes, because quite frankly, we really don't know yet about whether inflation is going to come out of the bottle, if you like, given the strong economic rebound with the vaccination rollout and potentially some pressure on wages.
So in terms of that, of course, here in Australia, there's a lot of debate, and even the RBA weighed in, that as long as the borders are shut, supply of labour is hard to find, wages start to pick up. Is this a thematic that we should be looking at when it comes to stock picking?
Well, once again, it's sort of a short-term issue. One of the things in regards to higher prices coming through, whether they be wage costs, or whether they be input prices, given the very strong balance sheets of the household because of the income support from governments, there's still a lot of demand out there. So companies are likely to be able to push through price increases in our view. So therefore, I was concerned about corporate earnings because of that, but it looks like because of the strong demand that's still out there, once the vaccination rollouts come, that companies can pass through those costs. So that's not a concern that we have at this stage from a corporate earnings perspective. But once again, it may put some pressure on inflation expectations, which are pretty benign at the moment.
They certainly are. Just to shift gears a little bit, and as we keep being told by everybody, RBA, FOMC, interest rates are going to be low for quite some time. And as my colleague Scuddy wrote this week, would some of these IPOs and companies exist if cash wasn't free and looking for a home?
No, they wouldn't. I mean, we've seen this in the unbelievable rollout and support for the SPACs in the US, where there was $83 billion of investors' capital flowing into the trust me sector of SPACs that will find something to buy. There's been over 100 odd billion go in already this year. I don't believe that in a more difficult environment where cash wasn't free, that these sort of companies would be able to attract the capital than what they're having. So I think it would be difficult to find that support. We've got perhaps the bellwether about to float in the States at some stage, the Robin Hoods. I think that could be probably a very good sign about where we are in the rampant speculation cycle.
Yeah, so that could well be the top, although we said the same thing about Coinbase. One to finish on, part of your notes which fascinated me, which basically said, to me this is a risk for superannuation choice going forward. I see a decade of negative real returns in a traditional 60-40. So if that's the case, what mixture would you recommend?
Well, I think asset allocation and the structure of portfolios are going to vary greatly over the coming decade. I mean, from a starting point of where we are now, we've got the cheapest money that we've ever really seen. You've got valuations that are as high as they've been in history. We've got corporate global debt, fiscal and corporate debt, at record levels. So I think the norm, and you've got, of course, bond rates down to levels now where you've got negative real rates. So I find it difficult from a starting point of excessive valuations, excessive debt, excessive speculation, to think a normal 60-40 portfolio can produce what it used to produce. And I think you need to look outside that in regards to some of the themes. So rather than the actual 60-40 split as such, where to invest in our view is, well, number one, being very diversified. So it's not just owning stocks, 60% stocks and 40% bonds. I think you need to be very, very diversified. And in that diversification, definitely have real assets. And that's land, agriculture, gold, non-residential property. I think is going to be very important to be able to provide a reasonable return, inflation somewhat protected, plus some income. I think some of the global themes are going to be very important: carbon capture, automation, alternative energy, and infrastructure is going to be a focus for portfolios. And then within the income, obviously not getting much income out of your cash. So perhaps, dividends from shares, loans, and rental income is going to be very important.
I think that's a wise way to finish off. Anything with income when cash is at zero will certainly be welcome. Well, thank you very much, Grant Patterson. Always a pleasure to have you from Providence Wealth. Enjoy your weekend.
Thank you. Have a great weekend, Annette.